Right. So price database. Let's say um, this is all do it yourself. Uh, so most of the stuff is on. Not most. 100% of the stuff is from freely available sources on the web. Right. So you have this NSE India website, and this is where you get the historical price, which is basically Bow copy, right? NSE India resources and historical reports, and then archives of daily and monthly reports. You have something called Bow copy, and let's say today's Friday is the today. So this is your Bow copy. Right. So I don't know about all the series. EQ is your equity. So there are about 6 to 8 series that NSE bifurcates each of the security that gets traded. B and BZ are in trade to trade segment where you need to, where you cannot day trade. The securities that you buy or sell will be settled after 2 days. Whereas EQ is you can day trade. They are settled. They are not settled immediately within 2 days, but you can trade them. Whereas BE and BZ, you cannot trade them till you get the stocks into your account, which is T+2, right? So that is BE, BZ. There will be so many series like E1 or and N1 things. So there are about 67. I really don't know this many were there. So quite a few of them are bonds, especially this E1, N1, N2, N3 and all, which you don't need to worry. Then there is, what is gold? The gold bonds that trade. What is the series for that? How many of you bought gold bonds?
SGB. Yeah, SGB.
That is GB, right? Gold bonds. How many of you bought?
I have it.
What is the INVIT?
Real estate investment trust.
No, that is right. INVIT.
INVIT, okay.
Bonds.
You are INVIT. Infrastructure investment fund or whatever. Usually, your target in a network way or state level. So they're all packaged and sold to, or not sold, formed as a company. So all that gets collected is earnings for that company. After the maintenance, salaries, all the expenses, whatever the profit this company makes, will give you in terms of the dividend. And it's a listed like a stock. This is your Nitin Gadkari's company, right? IRB. So this comes with IB series. So How many of you guys are in late 50s or 60s looking for a fixed income, monthly income from stock market? Okay, I mean, you don't need to tell me all personal stuff of yours, but these are the three InvITs. They pay fairly well, the dividend payout. You can check out, right? So this is about 60 rupees now, right? So 57. And assuming the last year dividend will be the same for this year. So last year, these are the dividends. So 20th January, 19th, 11th, 26th. How much is this total amount? If you can calculate it for me. Sorry? The first one, October is 2 rupees payout. Then again 180, there is another 2 rupees, so 4 rupees. And then you got 250 here, that is about 650, and another 250. So that is 9 rupees you got on a base of 60 rupees or 56. So that is 9 by 56 is how much? This is a correct only, right? 9 rupees. Yeah, so 2.2, 3.4, 4, 6.5, 7, 9. Yeah, 9 rupees, correct. So 9 on a base of 56 is 16% dividend yield, which is fairly high. But I think the last January, the price was also high. But yeah, so if you think you will get about 9 rupees next year, this is a high paying, dividend paying unit. Of course, you have to pay the tax on dividend, but this is the InvIT, right? So you can do further research on how you replace your fixed income portion in your portfolio with this. Yeah, so study other two InvITs as well. The only risk for this IRB InvIT fund is what is the risk?
Default risk, no?
Sorry?
There's a default risk, right?
I don't think Nitin Gadkari will default because you can't default. As long as you are paying, sorry, as long as you are collecting the tax, toll, the SEBI regulation itself will tell a portion of it. I think 80% of your earnings should be distributed as dividends. Some rule, I don't know what is the number. It could be 80%, it could be 90%. So there is no default risk. I mean, I cannot confidently say, but that is ruled out, the default risk, because you have to pay the toll and IRB collects the toll, and they will keep the expenses and rest they have to pay. So there is no default risk as such, I see.
Okay. So, okay, I understand. So what I mean is, what if the collections do not come for the IRB itself?
The only risk is, how many of you guys have burned your hands in Noida Toll? There was a stock called Noida Toll. How many of you are aware of that stock, Noida Toll? This toll.
I know, I know Parag Parikh Flexi Cap Fund burned its hands.
Yeah, I mean, like quite a few guys have burned their hands in this stock. Why?
I think
Invest
government
here
regulation,
because the dividend yield
government regulation.
government change the regulation, right? So something like that. This Arvind Kejriwal or whatever the nutcase said, you don't need to pay toll or some nonsense. So the bridge is now lying. So that is the kind of risk. IRB has 2, 3, I think eight tolls, out of which 2 tolls are in little sensitive zone in Punjab. If a new nutcase CM comes, that is the only risk that I see. But anyway, you would be spreading not only the IRB, the other 2 InvITs as well, right? So that's IV, and I don't think there is a special series for rates. What is the rate? Mindspace, right? Oh, yeah, there is a series. Sorry. So this is RR, real estate units or whatever. And these are the things which I invest, like GBs, InvITs, and RRs, and everything else is in equities, so EQ or BE. So I don't need to worry about the rest, because what will I gain by gaining so much general knowledge when I'm not using it, right? Out of the 67 that you have seen, the only important stuff for me are EQ, GB, RR, and IV or InvITs. So that's about your bow copy, right? So let's say I'm not interested in all, I'm only interested in EQ and BE and BZ, right? So these are the equities. So I have a symbol, and I'm not interested in all open, high, low, close. So I'm only interested in close. The difference between close and last is the last traded price, and close is the settlement price, which is 15 minutes volume weight. You have to use close because all your margins and everything gets calculated on close, not on the last price. Your shortfall on margin or anything is calculated on the close price. So close is the important stuff. You also can take the volume, but I'm sure I'm like 95% sure that you guys portfolios are not running in multi-crores where you need to worry too much about the volume. Just pay attention, which is what you need to do. That's all. You don't need to worry too much about the volume. Now, what are the stocks that you own? Let's say I own TCS, right? And I own SBI. How do I find the price from this?
VLOOKUP.
So I use VLOOKUP, right? So VLOOKUP of TCS, and it is the second item. So, yes. So TCS price today is 3833. SBI is SBIN, I think. So 502. Right. Now this is single day. Now what I also can do is this is date, I can download multiple files like this, right? So 21st December file is this. Similarly, I can download 20th December, right? I'm not downloading, I'm just putting, I'm interested in TCS and SBI, right? So I'll put some price, let's say 4,000. And this is 550. So in which case, how I construct my database is, I will just concatenate because my date and symbol are unique now, right? So concatenate date and symbol, that becomes some string. Now I want the same 21st December. What is the price of? And SBA, right? So this is, I have to concatenate in the same order. So my VLOOKUP now is M. So I have to put this in the same order. Right? So VLOOKUP of M2 in this database. So it is fourth item. So that's how I get the price for different days, right? And that's one small Excel hack that if you're already aware of it, it's fine. Otherwise, that's what I use. I will come back to this a little later. This is what we have seen now. Like, where do we download the data? This is something which you need to aware of. It is called CRSP. What is CRSP? That is Center for Research in Security Prices, Chicago Booth School of Business. This is the university in US, which is a pioneer in collecting the stock market historical prices and storing them. They publish the data, which is called CRSP database. The database of that goes back fairly long, probably 1950s or whatever. And because the company has corporate actions, the usual corporate actions are the price becomes too high, so they want to provide the liquidity, so they split the stock, right? Or they give bonus if they make too many profits, and they also keep giving the dividends, and sometimes some of the stocks give you rights entitlement. So the split adjustment is fairly simple. if the stock is split from 2 rupees face value to 1 rupee face value, all your prior prices like this, right? So will be off. So instead of 4,000, because TCS split is 2:1, this will become by 2. So instead of 4,000, it will become 2,000. Now there is this bonus adjustment. Bonus, how do they give? For every 2 stocks you hold, I will give you 1 bonus. So what does it look like? 2:1 bonus, right? What is the recent stock which gave the bonus? Famous stock. This guy gave a bonus recently, right? This is the place you see historical bonuses or dividends or what, corporate actions. So bonus is 2:1. So how do you adjust the stock price? Let's say today is 300 and yesterday is 300, just for the heck of it. This is today's price and today X bonus. So yesterday, this is pre-bonus. So what does it will become? 300. What is the price? Yesterday's price. Effective price.
Should be 450, right?
Sorry?
450.
No.
2:1.
Just by a ratio called A plus B by B. So A plus B by B is what here? 2 plus 1, 3 by B, which is 1. So it is 3 by 1. Anyway, so you know it is 3 by 1, it's not 3rd January. So this price is divided by that factor, 3 by 1 by 3. So it becomes 100. Yes, sir. Right? I would ignore dividend and because the dividend is a very small amount. So I'm not particularly interested in adjusting the dividend. But if it's a very, very huge dividend, you might want to adjust it by the same factor. So it is like 10% dividend yield. So yesterday's price will become 90% of the price, which is 100 minus 10% being the dividend. Usually it is small, so 1% or half a percent, 2% dividend. So I ignore it. This is Markovitch or Noble or at whatever it is, modern portfolio theory. This terminology looks like a little alien or very complex or anything. But the moment you start reading it multiple times, right, so it becomes little easy. There's nothing fancy about it. So I've given the links so you can read in your leisure time. As I said, even if the terminology looks complex, you don't understand the first time, so read it again. Read it again and understand whatever you understand. You don't need to understand all the 100% that is written there or is thought. You just need to understand 5-10% just for the heck of it. Then there is this thing called capital asset pricing model or CAPM. This entire equation is nothing but this one. You can see, right? Or you want me to blow it up? Expected investment return, that is RI, is nothing but RF, which is risk-free rate, which is basically the bank rate. Or if you want to be so accurate, what is the rate that you should be referencing? What is the current today's interest rate?
6.5, 10 years.
Yeah, but what is that rate? Who fixes it?
6.5. No.
It's not 6.5, it is 3 point something. But what is that rate that you should be referencing? Who gives you that interest rate?
GSEC, government.
Sorry?
GSEC, government.
RBI.
It is technically RBI is the one which sets interest rate, but for your minute technical details, you refer that as MIBOR, Mumbai Interbanking Rate or whatever. That is the rate which you should be referencing. So MIBOR interest rate is what today? Whatever, you go to the website, you will get that. This is the one, MIBOR overnight rate. So, Mumbai Interbank offer rate. Where is it published? Yeah, this is the one. Today's rate is this one, 3.5. Right, so that's your risk-free rate. And then you have something called beta into the same market return minus risk-free rate. That particular term called RM, which is the market rate minus risk-free rate or market expected returns. So what is the market expected returns? Typically like a benchmark, right? In Nifty, let's say 8% is the average annual return or whatever. And what is the MIBOR? What is the MIBOR rate?
3.5.
3.5, which we have seen. And Nifty average returns are 8. So 8 minus the 3.5. How much is that? 4%, let's say. That is what you call as a market risk premium. So the equation is very simple. Right now, is return on investment or expected rate of return of investment is nothing but risk-free rate plus beta into net market premium. So such a simple equation actually got Nobel Prize. Surprising, right? Isn't it surprising this A equals to B plus C kind of equation got a Nobel Prize?
Yeah, sir. Hindsight and the hindsight, it is very simple.
Anyway, so now whenever you make an investment or you already made an investment, you basically boast to your friends, right? So I made 50% or I made 10%, or sometimes you lose also. So that's your measurement, how your investments perform. Apart from your returns, these are the 5 important factors that you should be aware of or you need to know. Just say, for example, I will calculate the same investment returns for TCS. TCS I'm taking because it's a personal story of mine. I would have tinkered with hundreds of stocks so far in my life. I'm about mid 40. I started dabbling in stocks from the age of my first job, which is in at the age of 22 or 23. So you can imagine in 20 years how many stocks I would have touched. Of all the stocks, how much ever is that number may be, I made money in only 2 stocks. Money in the sense considerable dollar amount or rupee amount. You buy some junk stock and then sometimes you end up making 50%. But you won't be comfortable in putting even 10% of our capital. But there are some stocks where you are comfortable even to borrow on bank, personal, take personal interest, and then again put. So TCS or Infosys or stocks like that, your conviction is so high. I'm not saying you won't go wrong, but it's a reasonably zero, very less chance that you will go wrong if you invest in TCS. It will give you some money. So that's the reason TCS is my favorite stock. I made, there are only 2 stocks, as I said, I made money, which I remember. TCS and Infosys. I attempted with ITC last year, but it didn't work out. Right, so the reason, sorry?
ITC was part of your R square portfolio, right? Mainly.
Yeah. The reason that I came to BSc is it allows you to download a very long-term data, and you can do all this geometry like daily. I want a monthly data or I want yearly data. These features are not available in NS. So that's why I came to BSc website. Let's say I want a 10 years history, right? So this is giving data from 2010. Download. We are not interested in all this open, high, low, close volume. We are only interested in close price, right? We'll just only keep that data. This is from 2010. And you have to adjust for the splits and bonus, if any. So TCS split and bonus history. Money control or economic times or whatever. So they give this data here. So apparently this guy has announced bonus of 1:1 in April 2018. So what is the adjustment that you do now? For bonus, what is the adjustment?
Double the price on extra date.
A plus B by
B.
So A is 1, 1 plus 1 is 2, 2 by 1. So 2 is your ratio of adjustment. So from 2010, so 2018, April, right? This becomes half. So this is your TCS stock price. Has he given any splits? No splits. So you are done. We have done bonus and we have done split adjustments. Dividends, I said, forget, right? So this is your TCS closing price. Suppose you bought on January 10, so that's your starting date. This is your ending date. What is the price here?
367 on Jan.
67, right? And today's price is this one. Now you call something called CAGR. So how many number of years you invested? This is this minus this. So that's about 4,380 days. You convert that into number of years, which is 365.25 to be accurate. It's about 12 years. So your return is power this divided by this into 1 divided by how many years? So how much returns TCS has given?
21 compounded.
21.5% compounded annual. This is a different thing which you again need to be aware of. So my thing is every December, I'm buying one stock of TCS. Just one stock. How do I calculate my return?
XIRR.
Yeah, so it is a XIRR. So for it to be, for you to calculate XIRR, you need the dates to be in other direction. Oldest to newest. So you bought one stock. So you cash flow, something like that, you put a heading. So every year you are losing money, like you are giving from the pocket. How much? One stock minus 1 into. So you put 580 rupees from your pocket. So your investment is, I can't see because this ribbon shows me, but you can see what is the amount, total amount you have invested.
18,000 something, 18,000.
You can see on the right side. Okay.
Yeah, it's 18,567.
Whatever it is showing, right? Okay. Now, how many stocks you had? You have as of today? You have
12 stocks.
3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So what is the money that now you have? We have 12 into 3,700 is the price. So it is worth 44,000. So you put 0. These are the values and these are the dates. So what is the rate of return?
20%.
20.7% is your CAGR, not CAGR, XIR. That's how you calculate your XIR, which is a form of CAGR. Right. Apart from returns, you need to be aware of these factors, right? Standard deviation. We'll look at first standard deviation, right? So change percentage. Assume this is the same price in December 2019 as well. So this is your monthly changes. Average monthly change is how much per TCS? So on average, ECS gains by about 1.8% per month with a standard deviation of 6.5%. So what does it mean? 1.8 average returns and 6.5 standard deviation. What does it mean for you?
Means it moves around 6% from the mean on an average.
What it means is at a 67% confidence level, it is average plus 1 standard deviation. That is average plus 1 standard deviation. On the lower bound, it is average minus this. So with 67% confidence, I can tell in February it is going to move in between 8.5%, 8.3%, or 4.7% on the lower side. Now 95% confidence is
2 sigma.
2 sigma.
standard deviation, right? So what is that? It is average plus 2 standard deviation. On the lower side, average minus 2 standard deviation. And you have 99%, which is 3 sigma.
3 sigma.
That's what you need to be aware. Given those average and standard deviation figure.
Kora, can you just repeat the last part of the upper and the lower part?
Upper part is it can go up, the stock can go down, right? The upper bound is average plus standard deviation. 1 standard deviation, which is 67%. Lower bound is 1 minus 1 into average minus 1 into standard deviation. You got it? Or
Good.
all right, and then to know the other calculations, we need benchmark. So benchmark is, let's say, Sensex. Right? So where is the market data? Indices. Where are the indices? Okay, here. I want BSC Sensex because that's what my benchmark in this case. and monthly. And I want from January 2010. Even though I don't like BSC indices because it has this cute one-step download facility. That's why I'm using these. Like the same, like for TCS, I'm not interested in all the open, high, low flow scrap. I reverse. So this is my Sensex. This is alpha. We'll come back to that because we require beta to calculate alpha. So to calculate beta, what is the formula? This is one method. There are like multiple methods. Covariance divided by variance. That's one method. The other method is the slope method. Okay, let's calculate via this var covar method. Covar var method, right? Covariance the market and the underlying. That's your covariance divided by measures how the market moves relative to its mean. So variance of market. This calculation, you need to be consistent. Consistent in terms of you can pass either 10 years or 20 years or even 2 years. Always stick to one historical period. On a monthly data, typically it is about 10 years. And that's what I look at. On a daily data, which is very, very noise, you probably want to look at 5 years. Okay, so what is the beta of TCS?
The variance, variance we shouldn't take it for
Sorry?
TCS in beta in denominator. The variance should be
The slides. I will give the slides. You
okay, got it.
practice it. Like, I mean, you go back to the slides. You may not get everything at first to go. Take your time. Once you get the video, you practice it, right? Yeah, this is the formula where covariance of divided by variance of the stock. All right, so we got some numbers. So what does it mean? What is the beta of TCS?
0.47.
So what does it mean?
So for every 1 point of Sensex movement, this
It
TCS
moves
will
by
move 0.47.
0.47 factor.
Yeah.
So if Sensex falls by 1%, your TCS falls by 0.47%. If Sensex goes up by 2%, how much TCS moves?
0.47.
2 into 0.47. About 0.9% it goes up. That's what beta means. There is also another simple method called slope. I think this one, known y's and known x. That's also a way to calculate beta. I'll just, even though it's a repetitive, I will keep that for your reference. I have to save this. Right? I will provide this sheet. Where do I save it? Browse. Pick a folder. I will call that 23rd January. So this is TCS matrix. It is not a CSV file, it's an Excel. If I save as CSV, all the formulas will go. So you have to store as Excel. Right, so we are done with beta. Then what is alpha? Alpha calculation. Investopedia. You can go here because they fairly invest in good writers. So the guy at least knows the actual formula. He's not copying, he's copying it from his books or whatever. Where is the formula? It's called Jensen alpha. That's the technical term for these. This is the one, right? So just copy it, whatever. All right, so what is it? Portfolio return, right? What is a portfolio return? Average TCS returns minus risk-free rate, which is 3.5, but I'm not using 3.5. I'm just for the simplicity sake, I'm just setting that risk-free rate as 0, just to be simple, right? So that will go away. Then minus portfolio beta. How much is the portfolio beta? This one. Into market return. What is the market return? We haven't calculated. Let's say we'll calculate here. Minus risk-free rate. Risk-free rate is 0. So this is average Sensex. So this is monthly figure. This number needs to be positive. That means for the amount of risk you are taking, you are generating excess returns. So the monthly alpha figure for TCS is about you are generating 1.35% excess returns than the market.
Most formulas even don't consider the beta.
Sorry?
Most formulas on the internet don't consider the beta while calculating the alpha. Yeah.
Only raw returns, but you need to, this is how the actual way to calculate. You can't say I've got excess returns of 1.83 minus 1.01. No, that's not the way to quote excess returns. You have to adjust it for beta.
Understood.
Right. So you are done with alpha, beta, standard deviation. So what is the other risk metrics we need to be aware? What is the fourth measure? R squared. What is R squared? R2. This is nothing but correlation, right, of the stock and the market power 2. You can read what is R2 definition statistics. R squared is a measure that represents blah blah and everything, right? This. Is to analyze how difference of one variable can be explained by the difference in the second variable, right? What it means is if market is moving, how my stock moves. And how much I can explain. So that is the percentage figure. You can go through this video if you want to know more details about this number. Yeah, but for me, it is this number. What does it mean? I can explain TCS movements 12% of the times with that of Sensex movement. That's a technicality. So how do I read that number? There has to be a good or bad in that number, right?
Yeah.
So what is good R2? What is bad R2? You can easily tell alpha is
For the better.
I want a what is a good alpha? Anything above 0 is a good alpha, right? Anything below 0 is a bad alpha. Like that, if I tell R2 is 0.12, what is a good R2 and what is a bad R2?
Lower the better.
Yeah. So why it is? Let's say I've hidden the stock name TCS because I'm telling you it is TCS. I'm just telling you I have some investment proposal for you. These are the statistics. So if my R2 is 1, I can immediately tell all that you are doing is bullshitting because you are basically investing in Sensex. Anything close to 1, right? So I don't need to pay you anything because you are just doing what Sensex does. I also can do. I can actually go for a low cost index fund rather than paying you the money. It's as simple as that, right? Anything up to 0.9, you are still mimicking the index by 90% of the time. Now, in this case, my R2 is what? 12%. So I'm doing something not related to Sensex, right? Because it's only 12% of the time I'm mimicking Sensex. Rest of the 88% of the time I'm doing something different.
What is the number which we should be comfortable up to in terms of?
That's what. So if you say 1, you are not doing anything extraordinary. You are just following Sensex. Up to
Yeah,
point,
but
yes, you are basically mimicking Sensex. Prefer a lower value than 0.9. What
yeah,
is-
but R2 will always be positive. No, it can never be negative because it's
can
square.
be, no, it can be negative also. Minus, it can go up to -1.
But it is a
Sorry, it won't go. Correct. Where it's
it's
a
a square.
square. Yeah, it's always between 0 and 1. What is a good number? You decide. But anything closer to 1 is you are following Sensex. So it has to be lower than 0.9. What is lower than 0.9? I have no idea. Probably I will look for 0.7, 0.8. If you are quoting me 0.9, 0.95, I know exactly that you are doing like closer to Sensex. So I don't need to pay you anything extra. I rather buy a cheap index fund. Right? Does it make sense or no?
Yes. Yes.
That's
And then you have something called Sharpe ratio. So what is Sharpe ratio? Uh, expected value, asset return, risk-free return, and standard deviation of excess returns. Typically, right, because I am setting it to risk-free rate as 0, my calculations become simple. But let's say if I actually use the interest rate, risk-free. Right? What is the risk-free interest rate now? 3.5%. That's yearly. So monthly I get this much. Irrespective of market, I get about 0.00292% as a bank interest. Now, excess returns. Excess returns is TCS minus this. Now, what is the formula? Asset return minus risk-free return. Asset return. This is, we already have it. This one, right? Minus risk-free return. That's the numerator. And the denominator is standard deviation of excess returns. These are the excess returns. This is monthly figure. Now, to quote into yearly figure, you multiply by number of time periods. That is 12. So TCS Sharpe ratio is about, what is the TCS Sharpe ratio? 0.97, close to 1. What is bad? You can read on the internet. Anything in excess of 2 is extremely good. 1 to 2 is good. 0.5 is average, something like that. I would just pay attention to this number, but I won't worry too much. My worry is I want my Sharpe ratio to be better than Sensex. Calculate the same figure for Sharpe ratio for Sensex, and your investment needs to be better than Sensex. I mean, your Sharpe ratio should be better than Sensex Sharpe ratio. We'll calculate that also, right? So this is Sensex Sharpe, Sensex minus risk-free rate. Sensex Sharpe is Sensex average minus excess returns, sorry, minus risk-free rate divided by Sensex Sharpe into square root of 12. So Sensex Sharpe is 71. My investment Sharpe ratio is 97. So I'm faring little better than Sensex. So it is good. All right. So any questions so far? I think these are the various metrics that you need to be aware when you are making an investment, or your investment returns needs to be showcased like this, not, oh, I made 20% returns. Who cares whether you made 20% returns if market itself has given 20% returns, right? How much excess you generated? Did you generate excess returns or no? All right, so any questions so far? We done this, and we know how to calculate beta. We know how to calculate standard deviation and R2, R square.
So these numbers will vary month on month, right? So how do you average out over a period of time? I mean, this is at this moment of time, these matrices.
Yeah, do it once in a year. Don't bother.
Once in a year. Okay.
Like, are you going to evaluate your?
Yeah. So the period that we should look at it is always probably first month of the year or some fixed
Somewhere,
period.
yeah, you decide when you are going to review your investments. Do it once in a year. You can do it daily. You can do it even every minute, every hour also, because every hour this week.
It's too much noise then. So
There's too
basically,
much noise and they have other work to do, right?
yeah.
Now, this is another model that you, oh, I don't know what is that link. It's, I think, copied wrong. So what is that? Former French model. This is another Nobel Prize winning model. You can bash as much as you want the Nobel Prize guys, like idiots like Taleb and somebody does, right? But still, it has a respect. It's not that easy for you to get a Nobel Prize. Whether it's useful or not, it's secondary. But a Nobel is a Nobel, right? So this is the equation. So what is the equation? So these guys try to enhance the CAPM model or whatever. CAPM model is nothing but risk-free rate, returns or risk-free rate plus beta into something. That's what CAPM model. Now they extend it to next stage. They explain the entire any of the excess returns or something like that, or by some anomaly, like some extra thing is going on. And what is that extra thing? So returns or risk-free rate plus beta into the market returns minus risk-free rate returns, which we already see, plus some other number, some other beta into SMB, that is book market or book value. Sorry, SMB stands for small minus big, that is large cap minus small cap factor, and HML, and that is book value or book to market ratio into some beta number plus alpha. So it's not complex, it's very simple. Alpha plus risk-free rate return plus beta into this factor plus some other beta into SMB factor plus some other beta into HML factor. So that's about it. So you need to be aware of this factor or form of French model, whatever they call it. I don't use this. You also don't need to use it. But if you want, you can use it. You need to calculate this two things, SMB and HML, and then you have TCS figure, or what is the TCS or returns of TCS. You also know the risk-free rate return, which is 0%. You know beta of the TCS, which is, how much is the beta of TCS? 0.47. And then if somebody gives you this figure, again calculate beta coefficient of that SMB. And if somebody gives you HML matrix, calculate beta of that HML. And then you are left with this alpha. All that you are trying to do is calculating that alpha. So now alpha becomes, just keep it here, or minus, everything goes to the other side. So instead of this alpha, we get some other number. That's your real returns as per this model, Farmer French 3-factor model. All right, so we spent like an hour, right, so far. So in this 1 hour, we have actually used 3 Nobel Prize winning formulas. What are those?
Jensen's alpha, pharma French.
This entire risk matrix is called CAPM alpha. For this short ratio, that's another Nobel Prize. And again, the CAPM model, which I talked, the form of French, which is an extension of CAPM, that's another Nobel Prize. You won't be using Nobel Prize winning formulas in our day-to-day life regularly, right? All right. So we will take a 5-10 minutes break. If any questions, you can ask me. Otherwise, we will take a 10 minutes break. Any questions so far?
Kora, just one question.
Yeah.
This risk-free rate we have taken for all this throughout 10 years or 11 years, we have kept it same. But if we go, I mean, for simplicity only, if we want to get it accurately, we have to take the risk-free return for that period, right? For that year.
Sorry, I didn't understand.
Here, the risk-free rate, we have taken this 3.51 throughout the calculation.
Yeah,
for all
actually,
the-
you have to calculate the average of all the 10 years.
Okay.
It will be different in different parts, right?
Absolutely, absolutely.
Yeah.
So right now, just for the simplicity part, we have taken 3.51.
I think I have taken that as also as a 0 in some cases.
Yeah, in sharp calculation, yes.
Yeah, if I've taken 3.5 as current value, correct. But yeah, so if the interest rate was 5% here, right?
Yeah,
We have to use 5.
correct, correct. So just to get accuracy on higher side, we have to, keep checking the data.
Yes. Yeah.
Kora, on the adjusted data, is there any, because, for let's say 500 stocks, adjustments historical is going to be quite a task. Is there like some place where one can get this data?
You have to pay for the data. It's not free.
Okay, which is a good source that you recommend?
See, it depends. Depends in the sense. I'm not belittling you or anything. So how much is your investment? So if it is like 2-3 crores, you might as well buy any cheap data, or you can construct on it. If you are in the range of 100 crores, probably buy a Bloomberg terminal, which costs you $2,000 per month. Because Bloomberg is pretty accurate. So if your investment is only in 5-10 lakhs, you might as well, if you are a software engineer, you might as well write a script and download it from Yahoo, even though Yahoo is not accurate data. Right?
Okay, got it.
There are 20 lakhs, even if you commit a few errors, it doesn't matter. Right? All your errors will be this one. This figure will be wrong. That's it. If I quote 21.5 or 20.5, how does it matter? Right?
Right.
Now I cannot commit that mistake if I'm doing a 100 crore fund management or whatever. So I have to buy accurate data. But you don't need for all 500, maybe 200 stocks. So you download, you sit one day and you download like the way I download for TCS and adjust it. Might take 1 day, it might take 2 days, but yeah. So if you don't want to spend that money, you have to do that grunt work.
Got it.
All right, so we'll take 10 minutes break. What I'll do is I will stop the recording